So fourth time you've downgraded it. Total, you're looking at 40% decrease in earnings versus pre-virus levels. Are you done? Is it going to get worse than 40%?
Yeah, this is really amazing. I mean, each time we think we're where we need to be, and then we have to cut estimates again, as you said, for the fourth time. Banks are about to live the stress test that they've been practicing for a decade, and if successful, this could justify a re-rating higher. But first, it's earnings hell. No large bank is immune to the negative impact of higher unemployment and lower interest rates, and now we have credit losses up 2 to 3 times, earnings down maybe by a half over 2 years. And look out for negative guidance when banks report next week. And meanwhile, the U.S. government has a gargantuan task to make the stimulus work, getting the right money in the right place in the right time for something that's never been done before. So, yes, these are sobering times. Reported unemployment will likely pass the level of the global financial crisis. And the hope is that the government efforts cushion the impact and take maybe 15% headline unemployment and make it feel like under 10%. So the quote, feel like unemployment is what will matter more for the banks.
Mike, can we start distinguishing which banks are going to be worse off? Because you mentioned, lower interest rates and high unemployment. The Small Business Administration sort of trying to disperse those loans through banks. That's been a super rocky start, which has execution risk. So which banks are more exposed to all of that, and which can benefit from, say, more volatility, more trading? We've seen some crazy trading numbers coming out of the banks, an early read for what we saw in the first quarter. Can you help me distinguish?
Well, first I'd like to make the point is we ran over 100 earnings models under all sorts of scenarios, so we're deep in the numbers. And if you look out over 2 to 5 years, I know that's longer than many people's time frame, almost every large bank would be a buy. Having said that, there are some banks that are more exposed to, lower interest rates than others, such as, Comerica, which we have a sell rating on. On the other hand, we go either, high beta banks that benefit from high volatility or high quality. So high beta stocks would be companies like Citigroup or Goldman Sachs, which can benefit from volatility, although we reduced our estimates on them too, or high quality banks such as PNC and U.S. Bancorp. And you mentioned J.P. Morgan, they're also high quality. And, calling for Jamie Dimon, we will finally hear from him for the first time next Tuesday when they report earnings. So he can remind people why J.P. Morgan's of quality, how they have over $1 trillion in liquidity, J.P. Morgan itself, how they run daily stress tests. And you know what? It'd be even better if Jamie Dimon would buy stock again. He's done that during prior periods when the stock's taken a hit. So I think the industry has a potential boost when Jamie Dimon returns next Tuesday.